In the previous webinar, I explained the concepts of the primary and secondary market on the JSE to you. And I also looked at some of the complications which can arise when calculating a company's issued share capital. These are very important ideas, and if you are not clear on them, you should go back and watch that webinar again. In this webinar, I want to explain 8 important relationships which every investor should be aware of. And the best way to do that is by way of an example. So let us suppose that a certain company has 10 million shares in issue, and that company has made a profit in the most recent financial year of 22 million rand. Let us also suppose that the directors looked at that profit and decided to pay out a dividend of 6 million rand. Finally, let us suppose that the share price trading in the market right now is 1500 cents or 15 rand. Now, from those 4 pieces of information, we can calculate the 8 relationships which I referred to earlier. Let us begin with the earnings per share. Now, the earnings per share is simply the earnings or profit, and remember that those 2 words mean the same thing in the stock market, divided by the number of shares which the company has in issue. In our example, the company made a profit of 22 million rand, and it has 10 million shares in issue, so therefore the earnings per share is 220 cents or 2.20 rand. Now the dividends per share is a very similar relationship. You take the dividend and divide it by the number of shares in issue. In our example, the dividend was 6 million rand divided by the 10 million shares which the company has in issue, and that shows you that every share earned 60 cents per share as a dividend. The third relationship is the market capitalization. This is the value which the market places on the company. And we calculate it simply by multiplying the number of shares in issue, 10 million, by the current share price, which is 15 rand or 1500 cents. So that makes the market capitalization 150 million rand. The next relationship, the fourth relationship, is the retained income. Now you know that the company makes profits, and out of that profit they pay a dividend. What is left over after the dividend has been paid is retained or kept in the business to finance future growth. So we call that the retained income. In our example, we made a profit of 22 million rand, out of which a dividend of 6 million rand was paid, so 16 million rand was retained in the business to finance future growth. The next relationship is the dividend cover. Now the dividend cover is the number of times that the dividend could have been taken out of the profits. So all we do is we divide the profit of 22 million by the dividend of 6 million, and that gives us a dividend cover of 3.7. Now companies have different dividend policies. Some companies have a policy of paying out 100% of their dividend, or even more, drawing on profits from previous years. Other companies pay out no dividends because they are growing quickly and they need that money to finance that future growth. But most blue chip companies will pay out 25 or 30% of their profits every year as a dividend. And that is their dividend policy, and you can see it in the dividend cover. A share like Coronation pays out 75% of its profit as dividends, and that of course makes it very attractive to shareholders. Now let us consider 3 very important relationships: the dividend yield, the earnings yield, and the price-earnings ratio. Now the dividend yield we have covered before in a previous webinar, and maybe you should go back and have a look at that again to refresh your memory. But simply, it is calculated by taking the dividends per share and expressing them as a percentage of the current share price. So in our example, the dividends per share were 60 cents per share, and the share price is 1500 cents. So therefore, the dividend yield would be 4%. The earnings yield is very similar. We take the earnings per share and express it as a percentage of the current market price of the share. So in our example, the earnings per share was 220 cents. We express that as a percentage of the current market price, which is 1500 cents, and that gives us an earnings yield of 14.7%. Then finally, we have the price-earnings ratio. Now this ratio is the reciprocal or the inverse of the earnings yield. So whereas with the earnings yield, we take the earnings per share and express it as a percentage of the share price, with the price-earnings ratio, we take the share price and divide it by the earnings per share. So in our example, the price is 1,500 cents and the earnings per share is 220. So if we divide the 1,500 cents by the 220, we get 6.8. Another way of looking at that is that if you bought the share for 1,500 cents and the company carried on making 220 cents per year in profits, then it would take you exactly 6.8 years to recover the price that you'd paid for the share. So the price-earnings ratio is also called the earnings multiple by a lot of people, and it is very commonly used overseas. In fact, overseas you almost never hear of the earnings yield. You only hear of the price-earnings ratio or the multiple that a share is trading on. Now the dividend yield, earnings yield, and price-earnings ratio are all changing every day as the share price changes. So they tend to be quoted in the newspaper. One or all of them tends to be quoted in the newspaper every day. You may also find that the dividend yield is sometimes called just the yield, but remember, it is the dividend yield. And it's a very important relationship and will give you a clue as to whether the share is cheap or expensive. Now these relationships, all 8 of them, can be used to compare one company with another, or to compare the company with its sector. And you must learn how to use them and to understand them properly. They will help you to choose the right shares and to time your transactions for the best profit.